Intel stock closed its standard trading session on Friday, May 15, 2026, at exactly $108.77 per share, marking a significant intraday decline of 6.18% as the market wrapped up for the week. The trading volume surged to over 135 million shares, reflecting a massive wave of institutional repositioning and retail panic selling that outpaced the stock's typical daily liquidity. The sharp correction extended further into the after-hour session, dragging the price down an additional 1.74% to settle at $106.88. This dramatic drop managed to catch a vast portion of the market entirely off guard, especially considering that just a few days prior, the company was testing multi-month highs near $132.75. While the headline numbers point toward a brutal single-day sell-off, the real story here is not about a sudden fundamental failure, but rather a profound structural shift in how large-scale institutional funds are allocating capital across advanced semiconductor manufacturing assets. While retail traders using popular self-investing platforms were scrambling to find a definitive piece of bad news to explain the plunge, the smartest money in the market was quietly executing an options-driven volatility hedge, exploiting elevated short interest that has been quietly building behind the scenes. The sharp intraday drop has exposed a massive rift between the optimistic narrative surrounding the company's aggressive Foundry expansion and the cold, hard reality of its immediate cash flow constraints, creating a classic trap for anyone looking at this purely through a surface-level lens. The prevailing market narrative around Intel stock over the last few months has been overwhelmingly bullish, driven by a collective belief that the company's domestic manufacturing strategy would seamlessly position it as the premier alternative to overseas chip foundries. For a long time, the consensus on mainstream investing sites has been that the massive federal subsidies and strategic high-performance computing partnerships would automatically translate into immediate, highly profitable revenue streams. This widespread optimism fueled an explosive multi-week rally where the stock practically doubled, causing thousands of retail accounts on platforms like the Robinhood app to chase the momentum, operating under the assumption that the company had finally escaped its multi-year operational slump. The common ground among casual market participants was that the massive scale of the company's infrastructure footprint made it a safe, unassailable bet on the broader expansion of high-performance computing hardware. However, the harsh reality that institutional desks are now forcing the market to confront is that physical manufacturing expansion is an incredibly capital-intensive, low-margin endeavor in its early stages, completely detached from the high-margin software and design ecosystems that drive names like NVIDIA stock or Apple stock. When you peel back the layers of the recent trading data, you see that the company is currently carrying a deeply negative GAAP earnings per share metric of minus 62 cents, exposing a massive fundamental disconnect. Institutional investors utilizing advanced platforms like Interactive Brokers trading tools are looking past the media hype and focusing directly on the company's sub-40% gross margins and the notable absence of corporate insider buying, with $4 million in insider sales hitting the tape over the past quarter alone. The contrarian view that is now gaining massive traction among sophisticated asset managers is that the market vastly overextended the company's valuation, pushing its market cap over $540 billion on pure sentiment, while ignoring the operational drag of running incredibly expensive, unproven cutting-edge fabrication facilities. Looking closely at the recent price movement and institutional activity, the structural weakness becomes even more apparent when you observe how the stock handled key technical support levels over the last 5 trading sessions. After hitting that 52-week peak of $132.75, the stock suffered a series of systematic distribution days where heavy volume drove the price down through the $100 mark, culminating in Friday's aggressive 6% plunge that ultimately dragged down the entire tech-heavy QQQ index. This systematic selling indicates that major fund managers at organizations specializing in large-scale fidelity investment portfolios are actively trimming their exposure to reallocate capital into assets with more immediate visibility into free cash flow. This broader sector momentum is facing immense pressure from macroeconomic factors, particularly stubborn capital costs and tightening international trade restrictions that threaten the global supply chain of high-end manufacturing equipment. To fully understand why this expectation versus reality dynamic is pulling the stock in opposite directions, it is essential to examine the core business model and the structural framework of how this semiconductor giant actually operates. Historically, the company has functioned as an integrated device manufacturer, meaning it both designed the microprocessors that power the vast majority of the world's personal computers and servers and fabricated those chips in its own internal facilities. For decades, this vertical integration was an absolute goldmine, allowing the company to dominate the x86 architecture market and dictate the pace of global computing power. But as fabless design firms partnering with specialized hyper-efficient overseas foundries began capturing massive market share, the traditional business model faced an existential threat, forcing a radical corporate pivot into a split-structure entity, an internal chip design division, and a separate commercial foundry business operating as a contract manufacturer for third-party clients. This dual-track operational strategy means that the company is essentially running two incredibly complex businesses simultaneously under one corporate roof. On one hand, its client computing and data center divisions are fighting an intense, margin-eroding battle to protect their market share in the CPU space by rolling out new product lines like the client-focused Ultra series and high-performance server processors. On the other hand, the newly established contract manufacturing wing is burning through billions of dollars in capital expenditure to build out domestic fabrication plants, attempting to attract external tech giants to use their advanced packaging and manufacturing nodes. While recent quarterly reports showed a modest revenue increase of 7% year-over-year to $13.6 billion, the GAAP net loss reached a staggering $3.7 billion, proving that the immense cost of setting up these massive industrial facilities is actively cannibalizing the profits generated by the legacy chip design business. Please comment below with the exact number of shares of Intel stock you are currently holding in your portfolio, or tell me if you are completely avoiding this chipmaker right now. Sharing your real position helps everyone in the community see where the actual money is moving. When you look at how modern retail investors are interacting with this stock, you find a fascinating split in user behavior across various digital brokerage platforms. Investors utilizing automated asset allocation tools like Schwab Intelligent Portfolios or various robo-advisor algorithms are often finding themselves holding the stock simply because traditional index weighting models naturally pull in mega-cap technology names based on market capitalization rather than immediate profitability. Meanwhile, active self-investing enthusiasts using mobile-centric systems like the SoFi trading platform or the Robinhood app are frequently engaging in highly speculative options trading, betting heavily on short-term price reversals without fully accounting for the immense institutional short interest that continues to cap the stock's upward momentum. This friction between passive index tracking and aggressive retail speculation creates an incredibly volatile environment where a single macro headline can spark massive multi-million share liquidations in a matter of minutes. The deeper fundamental risk that many casual online investing participants tend to overlook is the intense competitive pressure coming from the broader semiconductor ecosystem. While this company is working tirelessly to secure host CPU placements in major artificial intelligence infrastructure buildouts, it remains structurally dependent on the overall capital expenditure cycles of a handful of cloud service providers. Unlike specialized chip designers who enjoy high asset-light margins, a capital-intensive foundry operator cannot easily pivot when market demand shifts. Those massive physical facilities must run at near maximum capacity around the clock just to break even on their massive fixed depreciation costs. Consequently, any slight delay in product validation or any minor cooling in global tech infrastructure spending immediately amplifies the financial strain on the balance sheet, explaining why institutional traders on specialized platforms like Interactive Brokers are demanding a much larger margin of safety before committing long-term capital. This brings us back to the core conflict between investor expectations and the underlying corporate reality as we project the future outlook for this stock. The dominant market expectation is that the company's extensive partnerships with global technology leaders and its participation in high-profile computing projects will act as an unstoppable catalyst, eventually driving the stock price back toward its historical highs. Optimistic analysts point toward projected revenue targets for the upcoming quarters, waging that advanced packaging demand and domestic supply chain security mandates will force domestic tech companies to channel billions of dollars into these newly minted facilities. This is the narrative that keeps the stock highly searched on retail investing sites and frequently discussed among users managing their personal portfolios through standard Fidelity IRAs or online investment accounts. The reality, however, is that the timeline required to achieve profitable, high-yield manufacturing at this scale is measured in years, not quarters, and the path forward is filled with significant execution risks. Over the next 12 to 18 months, the company must successfully navigate a highly complex operational transition while simultaneously managing intense macroeconomic factors, including shifting international trade policies, export controls, and potential semiconductor oversupply as global manufacturing capacity increases. If the upcoming quarterly earnings reports reveal further margin degradation or structural delays in facility buildouts, the institutional capital that recently fueled the momentum will likely continue its exit, leaving overextended retail portfolios holding the bag. Conversely, if the company can demonstrate a clear, accelerated path toward positive free cash flow and secure definitive, large-scale manufacturing commitments from major third-party chip designers, it could trigger a massive short squeeze that fundamentally re-rates the entire asset. In summary, the dramatic intraday drop to $108.77 perfectly highlights the ongoing battle between the grand strategic vision of domestic manufacturing independence and the immediate financial realities of a deeply negative earnings profile. While the broader public market remains enamored with long-term infrastructure narratives, the immediate price action reflects a cold calculation by institutional desks prioritizing current cash preservation over distant capital-intensive promises. Investors navigating this terrain must look past the superficial headlines found on standard digital trading apps and carefully weigh the immense capital expenditures against the actual operational yields. The ultimate direction of the stock will not be decided by market sentiment or retail enthusiasm, but by the company's strict operational ability to turn massive physical infrastructure into sustainable, high-margin profitability. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.